Modern militaries are facing a logistical math problem that traditional weapon stockpiles were never designed to solve. They are increasingly encountering saturation attacks from swarms of highly capable, extremely inexpensive drones. The central challenge for defense planners is the extreme cost-exchange ratio. When a threat platform costs only $35,000, exhausting a multi-million-dollar interceptor to stop it creates a financial deficit that no budget can sustain. For decades, the standard response has relied on heavy kinetic interceptors. These systems take years to manufacture and requires massive industrial footprints to maintain. This chart compares the exact cost discrepancy driving the current crisis. A traditional legacy interceptor costs anywhere from $100,000 to $3.9 million per launch. An AI-enabled counter-drone system accomplishes the same kill for $10,000 to $15,000. This cost asymmetry is no longer a localized tactical issue. It is a structural crisis, forcing a complete overhaul of how the military buys and deploys technology. The traditional defense industrial base is built around massive, hardware-first platforms. These projects often take years to reach the field and rely on long manufacturing cycles for every hardware refresh. A new wave of disruptors, known as neoprimes, are emerging from Silicon Valley. These contractors are designed to move at a faster pace, filling critical gaps in autonomous systems and AI. Their defining edge is a software-first architecture. Instead of waiting for physical hardware upgrades, these platforms receive over-the-air updates instantly, much like a smartphone or a commercial electric vehicle. SpaceX provided the foundational template. They disrupted legacy aerospace cadences by treating rockets as software-driven platforms that iterate and improve with every flight. While the trend towards software-first defense is evident, investing in this space requires navigating extreme valuation premiums and significant market volatility. Determining which companies provide actual value requires an evaluation framework based strictly on risk-adjusted returns rather than venture capital enthusiasm. Managing this capital transition requires looking past legacy brand names and aggressively calculating execution risk against current market multiples. We begin with the Tier 1 public pure plays, the companies actually manufacturing and delivering low-cost, attritable hardware to current conflict zones. Kratos Defense has established a first-mover advantage in unmanned systems, like their Valkyrie drone, supported by a growing international backlog and accelerating production capacity. This illustrates the valuation risk. Kratos trades at a price-to-sales multiple of 12.2, triple the industry average of 4.5. To justify that premium, Kratos must execute flawlessly to hit their target of $1.6 billion in revenue by 2026. For investors seeking hardware exposure with less volatility, AeroVironment acts as a more mature, lower-risk alternative in the drone sector. Their Switchblade loitering munition franchise is already proven in active combat, and analysts expect their revenue to climb to $1.28 billion by fiscal 2029. The trade-off is direct. AeroVironment offers lower drawdown risk and a defensible market share, while Kratos provides a higher speculative upside if they can scale their manufacturing successfully. For a conservative thematic sleeve, pairing these two stocks provides the highest quality expression of the low-cost drone thesis available with public liquidity. Moving from hardware to the software brain that coordinates them, Palantir serves as the foundational operating system for the entire counter-drone kill chain. The company's underlying fundamentals are strong, with 70% revenue growth in late 2025 and a massive 137% increase in U.S. commercial revenue. This chart shows the valuation premium. After an 81% price run-up, the stock trades at roughly 200 times trailing earnings. This multiple leaves little room for error, pricing in years of flawless execution. Adding aggressively here carries significant risk if growth slows. A more disciplined strategy involves holding existing positions and waiting for significant price drawdowns, typically in the 30% range, before deploying new capital. Palantir acts as a core AI infrastructure play rather than a traditional defense stock, requiring a different risk tolerance and a longer investment horizon. In the microcap space, Red Cat Holdings has emerged as a high-risk sleeper pick within the neoprime ecosystem. Their primary catalyst is the implementation of NDAA Section 709, a regulation that restricts foreign-made drone components from the U.S. military supply chain. This regulatory moat creates a structural advantage for U.S.-compliant platforms. Red Cat is using this opening to deploy hardware capable of navigating signal-jammed environments where traditional GPS-dependent drones fail. However, the risks are substantial. Red Cat remains in a pre-profitability stage, and microcaps of this size are subject to extreme volatility that can be difficult for standard portfolios to absorb. This should be classified strictly as an asymmetrical alpha play, requiring aggressive position sizing as a small satellite holding. A significant portion of the neoprime sector's valuation is currently concentrated outside the public markets. Endural Industries is the $28 billion standout in this category, preparing for a 2026 IPO and the launch of the first high-volume manufacturing facility for autonomous military hardware. Then there is Epirus, which is developing high-power microwave systems that can neutralize entire drone swarms simultaneously with a targeted non-kinetic pulse. Shield AI is another major player, valued at $5 billion for their work on the software layer that allows drones to fight in environments where communications are totally jammed. Investors should monitor these private companies closely. When they eventually reach the public market, they will likely trigger massive liquidity events that redefine the sector's valuation benchmarks. We can now synthesize these individual tickers and macro themes into a single evaluation framework. This quadrant chart maps the neoprime landscape, plotting expected volatility against proven market execution. Conservative portfolios focus on AVAV and Kratos. Speculators manage small positions in Red Cat, while AI investors wait for pullbacks in Palantir before deploying capital. The underlying economics of modern warfare have shifted. Long-term portfolio survival now depends on backing the software-first disruptors that are engineered for this new financial reality.